Something unprecedented just happened in global finance, and most people didn't even notice. While diplomatic talks between Chinese and American officials were taking place behind closed doors in Malaysia, Beijing quietly executed a financial maneuver that caught Washington's central banking system completely by surprise. China released $4 billion worth of sovereign debt instruments in Hong Kong, but here's the twist. These bonds weren't denominated in yuan. They were denominated in US dollars. At first glance, this might seem like routine government financing, the kind of transaction that happens dozens of times each year across different nations. But dismissing it as ordinary would be a fundamental misreading of what's actually taking place. What we're witnessing isn't just another bond sale, it's a calculated challenge to the architecture that has supported American financial supremacy for more than 7 decades. In essence, Beijing is weaponizing the dollar against itself, using America's own currency as leverage to gradually erode its global monetary privilege. The ramifications of this move extend far beyond the immediate transaction. We're talking about potential shifts in how capital moves around the world, how investors perceive risk, and ultimately, who controls the financial strings of the international system. So what prompted China to issue dollar-denominated debt at this specific moment in history? What strategic calculations are driving this decision? And what kind of high-stakes financial chess game is unfolding beneath the surface of official statements and diplomatic pleasantries? Before we dive deeper into this story, if you find this kind of analysis valuable, please subscribe to the channel and turn on notifications so you don't miss our upcoming content on global economics and geopolitics. Now, let's unpack what's really happening here. The unusual nature of this bond issuance. Under normal circumstances, when governments around the world issue sovereign bonds, essentially IOUs backed by the full faith and credit of the nation, they do so in their own domestic currency. The United States issues treasury bonds in dollars. Japan issues government bonds in yen. European nations operating within the Eurozone issue debt in euros. This is standard practice, and there's a logical reason for it. Governments have direct control over their own currency supply and can manage repayment more predictably. But China's recent bond issuance breaks from this pattern entirely. Despite being the world's second-largest economy with its own established currency, Beijing chose to issue these bonds in US dollars through Hong Kong's financial markets. Historically, when countries take this unusual step of borrowing in foreign currency, it typically signals one thing. They're experiencing a shortage of that foreign currency and need to raise it through international debt markets. Here's where things get interesting. China doesn't have a dollar shortage problem. Not even remotely. Consider the numbers. In September alone, China recorded a trade surplus exceeding $50 billion. That's just 1 month. Over the course of a full year, these surpluses accumulate substantially. On top of that, China's foreign exchange reserves, the stockpile of foreign currencies held by its central bank, currently stand at over $3 trillion. That's trillion with a T. When you put that into perspective, the $4 billion raised through this bond issuance represents barely more than a rounding error in China's overall financial position. This clearly isn't about desperately needing to raise cash to cover immediate obligations or fill gaps in foreign currency reserves. So if it's not about the money itself, what is it about? The real significance, market reception, and pricing. The actual amount raised matters far less than how the market responded to these bonds and what price investors were willing to pay for them. To understand why this is significant, we need to grasp a fundamental principle of debt markets. Every loan, whether personal or national, comes with an interest cost that reflects perceived risk. Imagine you lend someone $100 and they promise to pay you back $105 in 1 year. That $5 difference represents a 5% interest rate, your compensation for lending your money and accepting the risk that you might not get it back. Sovereign bonds operate on exactly the same principle, just at a much larger scale. The interest rate, or yield, on government bonds functions as a price tag for that nation's creditworthiness. It's how markets express their confidence or lack thereof in a government's ability and willingness to repay its debts. When a country can issue bonds at very low interest rates, it signals strong credit standing. Low rates mean investors have high confidence in the borrower and are competing vigorously to buy those bonds. When many investors chase the same bonds, the issuer gains pricing power. They can be selective and work with investors willing to accept lower returns. This drives borrowing costs down even further. Conversely, when sovereign bond yields rise, it typically indicates eroding market confidence. Fewer buyers show interest, liquidity dries up, and to attract the necessary capital, the government must offer higher yields to compensate investors for perceived increased risk. It's supply and demand economics applied to national debt. Now here's the critical detail about China's dollar-denominated bond issuance. The interest rate on these bonds came in lower than comparable U.S. Treasury bonds issued during the same time frame. Let that sink in for a moment. International investors were willing to accept a lower return on Chinese government debt denominated in dollars than they would receive from American government debt also denominated in dollars. This sends an extraordinarily powerful signal to global financial markets. It suggests that major institutional investors, the pension funds, sovereign wealth funds, insurance companies, and asset managers that move billions of dollars daily, may now view China's sovereign credit as more stable, more reliable, and potentially safer than that of the United States itself. Challenging the federal funds rate benchmark. The implications become even more profound when we examine where these bond yields sit relative to the Federal Reserve's benchmark interest rate, the federal funds rate. Most people aren't familiar with how this rate actually works, so let's break it down. The federal funds rate isn't a single fixed number. It's a target range with an upper and lower bound. The upper limit represents the rate at which the Federal Reserve will lend funds directly to financial institutions, essentially the highest cost for borrowing in the U.S. dollar system. The lower limit represents the rate banks earn when they deposit excess reserves with the Fed, the floor for returns on the safest possible dollar-denominated holdings. For decades, this range has served as the global economy's anchor. It's been the universally recognized benchmark for pricing risk and return on dollar-denominated assets. Every major financial institution in the world uses it as a reference point when making investment decisions. Now consider what it means if China issues dollar-denominated bonds with yields approaching or even falling below the lower bound of this federal funds rate range, and international investors eagerly purchase them anyway. This scenario would prove two things simultaneously. First, it would demonstrate that global capital is beginning to question whether keeping money parked in U.S. financial institutions truly represents the safest option anymore. If investors perceive emerging risks to dollar deposits or U.S.-based assets, they'll look for alternatives, and this would trigger flows of dollars toward China rather than toward the United States. Second, it would show that capital markets are voting with actual money, not just words. Investors would be signaling their belief that lending to China offers greater safety and more favorable conditions than depositing funds with American banks, even if the interest rate is marginally lower. They're essentially saying they trust China's creditworthiness more than they trust the stability of keeping dollars in the U.S. financial system. This financial dynamic, really poses an existential threat to one of the dollar's most important characteristics: its status as the world's ultimate safe haven asset. For generations, global confidence in safe assets has been almost exclusively centered on the United States. Whenever uncertainty strikes, whether from economic crises, geopolitical conflicts, or financial market turmoil, investors worldwide have reflexively moved their capital into dollar-denominated assets, particularly U.S. Treasury bonds. But as China's economy has grown in both size and sophistication, and as its sovereign creditworthiness has strengthened in the eyes of international investors, something fundamental is, honestly, shifting. Beijing is emerging as an alternative safe haven, another destination where capital can seek refuge during times of global stress. The most immediate consequence of this shift is that the United States will no longer be able to effortlessly absorb global capital flows at will, a privilege that has enabled Washington to fund massive fiscal deficits and maintain extraordinary influence over the global economy. Let's consider how the traditional playbook has worked. Throughout recent history, American foreign policy and intelligence apparatus have, intentionally or not, benefited financially from geopolitical instability in other regions. When conflicts erupt, when sanctions are imposed, or when financial systems in other countries face disruption, risk-averse investors typically move their wealth to what they perceived as the safest destination, U.S. markets. Take the Kosovo War in the late 1990s as a concrete example. As military conflict engulfed the Balkans and geopolitical tensions rose across Europe, investors pulled more than $700 billion out of European markets in a remarkably short period. The vast majority of that capital flowed directly into American markets, helping to fuel an economic expansion that continued for 90 consecutive months, one of the longest growth periods in U.S. history. Once China becomes firmly established as an alternative safe haven in the minds of international investors, this dynamic fundamentally changes. Even if just one-third of the capital that would have previously flowed entirely into U.S. markets during times of crisis instead moves toward China, the impact on American financial conditions would be impossible to ignore. Under these new circumstances, Washington would lose the ability to casually leverage geopolitical tensions for economic gain. The old strategy of creating or exploiting regional conflicts to trigger capital flight into U.S. markets would become significantly less effective, because the harvesting path would now be intercepted, at least partially, by China offering an alternative destination. 3 deeper strategic implications. Beyond this broad challenge to dollar hegemony, China's issuance of dollar-denominated sovereign bonds carries at least 3 additional strategic dimensions that, honestly, most analysts have kind of overlooked. First, disrupting debt trap diplomacy. In addition to profiting from crisis-driven capital inflows, the United States has historically employed another mechanism when dealing with resource-rich developing nations. Debt trap diplomacy executed through dominant financial institutions like the International Monetary Fund and the World Bank. The pattern is, well, pretty well established. Western financial institutions, often with implicit U.S. government backing, offer loans to countries that possess valuable natural resources, oil reserves, mineral deposits, strategic ports, agricultural land, but are facing immediate financial pressures or seeking development funding. These loans, however, rarely come without strings attached. Borrowing countries are frequently required to pledge critical state-owned assets as collateral. Mining operations, oil fields, ports, even agricultural land become leveraged against the borrowed funds. Additionally, loan agreements often contain restrictive clauses dictating exactly how the funds must be spent, which contractors must be used, or which policy reforms must be implemented. The purpose of these conditions, whether stated openly or not, is to increase the probability of default. When repayment deadlines arrive and the borrower struggles to pay back both principal and accumulated interest, the lender, under the guise of risk management and fiduciary responsibility, moves to seize control of the collateralized assets through debt restructuring mechanisms. These assets are then typically auctioned off, and the buyers are almost invariably Western financial conglomerates or investment firms with close ties to U.S. and European capital. They acquire these strategic resources at prices dramatically below their true market value, effectively transferring national wealth from developing countries to Western private interests. This isn't theoretical or conspiratorial. It's documented and repeated across multiple continents. Zambia's extensive copper mining operations, Central American energy infrastructure, and more than 70% of Argentina's state-owned enterprises have at various points been transferred to Western control through exactly these mechanisms. Now, If China successfully raises substantial capital through dollar-denominated bond issuances, it can redirect those funds into strategic lending to countries at risk of falling into these debt traps. For instance, China could provide loans to nations like Egypt, Democratic Republic of the Congo, or Pakistan specifically to help them repay maturing debts to Western creditors, preventing defaults and protecting their strategic assets from being seized. China has already begun implementing this strategy. Last year, for example, part of the multi-billion-dollar financing China completed in Saudi Arabian markets was subsequently used to support infrastructure development in Latin American countries, reducing their dependence on IMF and World Bank funding, and effectively cutting off the mechanism through which Washington exercises financial leverage over those nations. Second, accelerating renminbi internationalization. Although China borrowed US dollars through this bond issuance, there's nothing preventing Beijing from repaying these obligations in renminbi when they mature. For international investors, this currency substitution might actually be attractive rather than problematic, especially given current market conditions. The Federal Reserve is widely expected to enter a sustained interest rate cutting cycle, and simultaneously, international capital continues flowing into Chinese markets at increasing volumes. Under these conditions, the renminbi's exchange rate outlook is strengthening. In a currency appreciation environment, the earlier an investor acquires renminbi holdings, and the larger their position, the greater their potential gains from currency appreciation over time. Because of these dynamics, even if China offers to repay dollar-denominated bonds in renminbi, many institutional investors would likely accept or even prefer this arrangement. As these renminbi holdings are subsequently used for trade settlements, investment allocations, and asset purchases across global markets, the practical scope of renminbi usage naturally expands, further advancing its internationalization without requiring forced adoption or bilateral agreements. Third, creating inflationary pressure in the United States. As the renminbi's role expands in international commerce and finance, the world's aggregate demand for US dollars will inevitably decline. This creates a significant problem for the United States. Dollars that are no longer being utilized or held abroad will flow back into the domestic American market. The United States already faces severe excess liquidity challenges. The dollar has been overissued for years through massive quantitative easing programs, deficit spending, and accommodative monetary policy. The Federal Reserve's reluctance to cut interest rates aggressively, despite political pressure, has been driven primarily by the need to contain inflation by keeping some of this excess liquidity locked up in higher-yielding assets. But this approach is reaching its limits. Political pressure, particularly from figures like former President Trump and other influential voices, continues mounting on the Fed to reduce rates to stimulate growth and employment. Once the Fed capitulates and begins a new cutting cycle, the newly released liquidity from lower rates will combine with idle dollars flowing back from overseas markets as global dollar usage declines. When these two waves of liquidity converge, domestically released funds meeting repatriated dollars, the buildup of capital in U.S. markets will intensify dramatically. This double overflow of liquidity will inevitably place substantial upward pressure on American prices, potentially reigniting the kind of inflation that the Fed has worked so hard to suppress over the past several years. A sophisticated, multi-layered strategy. When you step back and look at the complete picture, China's issuance of U.S. dollar-denominated sovereign bonds represents a remarkably sophisticated and interconnected strategic initiative. For decades, only the Federal Reserve held the authority to create dollars through monetary policy, and only the U.S. Treasury could issue Treasury securities backed by the American government. Together, these two institutions monopolized what economists call seigniorage, the profit derived from issuing currency, keeping the entire system firmly under Washington's control. Now, as China establishes itself as a credible safe haven destination for global capital, It's not only issuing dollar-denominated bonds on a recurring basis, but also deploying the dollars it raises according to its own strategic priorities, rather than Washington's preferences. This effectively breaks the long-standing monopoly in which dollars could only be controlled, allocated, and weaponized by the United States itself. The geopolitical implications cannot be overstated. At this particular moment in history, China may be the only nation with sufficient economic scale, military deterrence capability, and geopolitical positioning to execute this strategy without facing severe retaliation. If virtually any other country attempted something similar, openly challenging dollar dominance and competing for safe haven status, they would likely face coordinated financial sanctions, diplomatic isolation, or even military pressure. American naval assets would probably appear near their shores with concerning regularity. But China operates in a different category. Its economy is deeply integrated into global supply chains. It's the largest trading partner for more than 120 countries, and it possesses sufficient military capacity to deter conventional pressure. This unique positioning allows Beijing to pursue financial strategies that would be impossible for smaller or more vulnerable nations. What this means for the future of global finance. We're witnessing the early stages of a fundamental restructuring in how global finance operates. For 3/4 of a century, the international monetary system has been organized around a single dominant currency backed by a single dominant economy with unmatched military reach. This system, sometimes called the dollar standard or Bretton Woods II, has provided the United States with what some economists call an exorbitant privilege: the ability to borrow in its own currency at low rates, run persistent trade deficits without immediate consequences, and impose financial sanctions that can cripple other nations' economies. China's dollar bond strategy chips away at multiple pillars supporting this system simultaneously. It challenges the assumption that only U.S. assets represent true safety. It creates alternative channels for dollar allocation outside U.S. control. It accelerates currency diversification away from dollar dependence. And it demonstrates that emerging powers can operate within the existing financial architecture while gradually reshaping it to their advantage. This doesn't mean the dollar will collapse tomorrow or that American financial dominance will vanish overnight. The U.S. dollar still accounts for approximately 60% of global foreign exchange reserves, roughly half of international trade invoicing, and the vast majority of commodity pricing. The infrastructure supporting dollar dominance, from SWIFT payment systems to correspondent banking networks, remains deeply entrenched. But dominant positions can erode gradually before collapsing suddenly. The British pound sterling maintained its status as the world's primary reserve currency for decades, even as Britain's relative economic power declined, until circumstances finally forced a rapid transition to dollar dominance in the mid-20th century. Historical precedent suggests that once confidence begins shifting, the process can accelerate in unexpected ways. For international investors, businesses, and policymakers, the strategic implications are clear. The era of unquestioned dollar hegemony is entering a new phase. Prudent actors will diversify their currency exposures, develop contingency plans for a more multipolar financial system, and pay close attention to how capital flows respond to future geopolitical developments. For the United States, the challenge is equally clear. Maintaining dollar dominance will require more than military might and historical inertia. It will demand responsible fiscal policy, credible monetary management, and perhaps most importantly, persuading international investors that U.S. assets genuinely offer superior safety and returns compared to emerging alternatives. That's a more demanding standard than Washington has faced in living memory. Closing reflection. What China accomplished with this $4 billion bond issuance extends far beyond the immediate transaction. It represents a proof of concept, a demonstration that alternative financial architectures are possible, that dollar dominance isn't inevitable, and that rising powers can use the existing system's tools to gradually reshape that system itself. Whether this marks the beginning of a genuine transition toward a multipolar financial order or merely a temporary challenge to American monetary supremacy remains to be seen. What's certain is that the rules of international finance are being rewritten in real time, not through dramatic announcements or international conferences, but through quiet, calculated moves in bond markets and capital flows that most people never notice. The question isn't whether this matters. It does, profoundly. The question is whether policymakers, investors, and citizens understand what's happening quickly enough to adapt to the implications. Because in global finance, by the time everyone recognizes a fundamental shift has occurred, the opportunity to position advantageously has usually already passed. If you found this analysis valuable, please subscribe to the channel and enable notifications so you don't miss our upcoming coverage of global economics, geopolitics, and the forces reshaping our financial future. The story of how power shifts between nations is being written right now, and understanding these developments isn't optional for anyone who wants to navigate the coming decade.